Breaking news, hot off the presses. This is Dawn Connors at Mortgage One. Before we get started, please like, share, subscribe to my YouTube channel. I would love that. All right, let's get started. Breaking news, as I said before, FHA just released new guidelines on student loans. This is really, really huge if you have student loans, and a lot of them. So previously, let's talk about previously what the guideline has been for years and what it is now. So previously, if you had FHA loans, let's call it $50,000 in FHA loan balances, then no matter what, with a government type of loan, I had to count 1% of your loan balance as a required payment, even if you didn't make that payment, even if your payment was zero, even if your income-based repayment was $10. So 1% of your loan balance, that's $500 a month. $500. So even if you only made $10 a month in a payment, I had to act like and put into your what's called debt to income ratios $500 a month. And did you know, according to the National Realtors Association, loans get turned down 27% of the time because of debt to income ratios. So let's talk a little bit more about that. If you have a $500 payment that's counted against you, that gives you a lot less buying power. For example, $500 a month is worth $100,000 in mortgage buying power. $100,000 at $500 a month. That's good mortgage buying power, right? And so what happens is student loans can often erode into your purchasing power on government loans because I have to count that huge payment against you. If you have $100,000 in student loan debt, that's $1,000 a month. So now I got to say that you can afford this house payment with $1,000 a month student loan payment and a new house payment of $1,200. Now that's $2,200, and then divided by whatever your income and your other debts. So what is the new rule? How has it changed? Let's talk about that now. The new rule is that it has been cut in half, literally sliced in half. So either whatever is reported on your credit report or 0.5%. So let's say that 0 is reported or your student loans are deferred. I can't count 0, I have to count 0.5%. So now instead of $500 a month for that $50,000 student loan balance, it would be $250. So that gives you freedom of another $250 a month, which is worth $50,000 in mortgage buying power. Pretty cool, right? So breaking news for sure. If you can prove what your student loan payment is, then I can also use that instead of the 0.5%. So it's either 0.5% or the proven student loan payment that's reported in the credit report or that you can provide to me from the student loan company. This is Dawn Connors at Mortgage One, providing fantastic mortgage solutions. And hot off the presses, this is pretty breaking news. So if you have a loan that's already pre-approved and you have student loans, you can go back to your lender and have it re-approved with this new guideline and get yourself more pre-approval, more buying power due to this new rule. It takes effect immediately. Thanks for watching.